Ladies and gentlemen, good day, and welcome to the SD Retail Limited H1 FY26 Results Conference Call hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ganesh sir from Kirin Advisors. Thank you, and over to you, sir.
Thank you. On behalf of Kirin Advisors, I welcome you all to the conference call of SD Retail Limited. From management team, we have Mr. Hitesh Ruparelia, Chairman and Managing Director, Mr. Utpal Ruparelia, Managing Director, and Mr. Ritesh Sarawgi, Chief Financial Officer. I now hand over the call to Mr. Utpal Ruparelia. Over to you, sir.
Good afternoon, everyone. I am Utpal Ruparelia, Managing Director of the company. Thank you for joining us today for the SD Retail Limited earnings call for the first half year, financial year 26. It's a pleasure to connect with you and share our performance highlight, strategic progress, and outlook as we continue building Sweetgreen into India's most trusted sleepwear brand. At SD Retail, we believe sleepwear is more than apparel. It's a daily ritual of comfort, expression, and care. Our mission is to make sleepwear an essential part of every Indian household, blending thoughtful design, inclusive sizing, and practical elegance for all age groups. Over the past few years, we have transitioned from a trade-led model to modern consumer-first brand with a robust retail and digital presence. Today, Sweetgreen reaches customers across India through exclusive brand outlets, multi-brand outlets, large format stores, and leading e-commerce platforms. We operate in a category that is deeply personal yet under-penetrated. Sleepwear is worn nearly 70 hours a week, but occupies less than 10% of wardrobe space. This gap represents one of the most compelling opportunities in Indian apparel, and we are committed to bridging it through design innovation, immersive retail experiences, and storytelling. I now request our Chairman and Managing Director, Mr. Hitesh Ruparelia, to take the call forward.
Thank you, Mr. Utpal. I, Hitesh Ruparelia, will be sharing our performance highlights, key developments, and future outlook with you during this session. Performance highlights. For H1 FY26, we reported revenue of 78.30 crores, a year-on-year growth of 9.23% compared to rupees 71.68 crores in H1 FY25, driven by higher revenue contribution from EBOs. Gross margin improved to 55.53% in H1 FY26, up from 48.82% in HY FY25. EBITDA stood at 2.18 crore versus 2.43 crore last year, while PAT turned positive at 0.13 crore, a significant improvement from a loss of 0.53 crore in the same period last year. Retail continues to be our growth engine. As of September 30, 2025, we operate 64 EBOs, up from 51 at FY25 close. With accelerated store openings expected in H2 FY26, we reached 68 EBOs as on October 31st by adding 4 new stores in the last month. Several additional locations are under fit-out and scheduled to launch in the second half. Now I will speak about market dynamics. The first half saw muted discretionary consumption across India, driven by anticipation of GST rate reductions and inflationary pressures. However, with the GST revision now in effect, cooling inflation, and an early onset of winter in northern markets, we expect a strong rebound in consumer demand in H2. Geographic footprint and store experience. Our north and west zones remain dominant, housing 56 stores, while the south zone is gaining traction with 8 operational EBOs. These stores serve as brand experience centers, space where customers engage with the Sweet Dreams lifestyle. We continue to enhance store productivity through efficient formats, mood-based visual merchandising, and inclusive sizing. Our stores are designed to evoke warmth and relaxation and optimized lighting, tactile fixtures, and storytelling that resonates with consumers between 8 p.m. and 8 a.m. To ensure consistency, we formalized visual merchandising protocols and conduct regular audits. Real-time customer feedback now directly informs product design and range planning. Role of technology and digital strategy. Technology remains central to our growth. We have migrated all our core systems to a cloud-native infrastructure, enabling real-time visibility and faster decision-making. Our teams now leverage over 20 custom low-code and AI tools across operations, recruitment, marketing, and design. On the digital front, we are strengthening our own e-commerce platform to deliver a seamless omnichannel experience, integrating inventory, reducing delivery times, and offering personalized content. This integration is expected to drive growth across our website and marketplaces like Myntra. We are also exploring data-led collaborations with lifestyle platforms and event partners to expand customer touchpoints. Now I will highlight people and processes. Our journey is powered by our people. We continue to recognize our EBO managers and ground teams who embody the Sweet Dreams ethos. We have expanded our retail and operation teams, bringing specialists across merchandising, customer insights, and visual merchandising to ensure flawless execution. Operationally, we have simplified documentation and processes, reducing store-level escalations by 30%. These steps are helping us scale with discipline and consistency. Looking forward. As we move forward, our focus remains on scaling Sweet Dreams into a truly national brand, both in reach and resonance. We aim to deepen our EBO footprint in Tier 1 and 2 markets, targeting airports, high streets, and malls that lack dedicated sleepwear destinations. Our vision, a Sweet Dream story in every major shopping district. We are building a unified omni-channel ecosystem with integrated stock visibility, loyalty benefits, and faster fulfillment. Our design teams are working on climate-responsive collections, coordinated sets, and fabric innovations tailored to India's diverse lifestyle. A unified CRM and loyalty program will soon be rolled out to deepen customer relationships and enhance lifetime value. We believe the sleepwear category is at an inflection point. With our focused strategy, differentiated product line, and technology-led retail model, SD Retail is well positioned to lead this transformation. Before I conclude, I want to extend my sincere thanks to our shareholders, customers, partners, and the entire team for their continued trust and commitment. The first half of FY26 has reinforced our belief that the future of sleepwear in India is bright, and the Sweet Dreams will continue to be at the heart of it. Thank you, and we now welcome your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Vipul Lamba, who is an individual investor. Please go ahead.
Yeah. Thanks for taking my question. Sir, first, I think the numbers look encouraging versus how was the last, second half of the last year. I believe they now with more reviews coming, the numbers look encouraging. But now I think for first half, 25% of our revenue is coming from EBO, right?
Yes.
So for the overall on a whole year basis, can we consider it will remain 25%? I mean, versus 18%, I think, which you guided earlier.
We said, see, our business model is that our H2 for the other channels is fairly large. So we expect the 25% to bring down to close to 20% by the year end. But yes, the growth of EBO has been quite significant.
Okay. Because last year, I think first half and second half both remained 13%. So that is why I was asking. Last year was both first half was also 13 and last second was also 13. So you're saying this time it will remain 20. And so from EBIT perspective, what we've been saying that despite increase in revenue from EBOs, our EBIT percentages rather has reduced. I understand that maybe because of new store opening, upfront cost. But what do you see? When do we see uptick here in terms of from an EBIT perspective?
Hello, Vipulji. This is Ritesh here, CFO of the company. So Vipulji, you are absolutely right. Currently, we are investing in building up team and other expenses to escalate the business. So we are anticipating that next year, second half is when we will start seeing the differential margin gains, because we will have a substantial chunk of stores that will be active and business will start rolling out from them. Still, if you will see, we are just 20, we are expecting 20, in the range of 20 to 25% of the contribution of stores by the year end. That will become marginal, much better by the end of the first half next year.
Okay.
So next year, second half, we are expecting that the margins will start improving. That you will start seeing the difference.
Okay. For second half, I mean, what is the margin which you consider will be achievable in terms of EBITDA margin? Last year it was approximately 11.7%. So what do you think what would look like? Because I think gross margins are going up. So any improvement in this year as well or no? Or we will maintain the same or it will go down?
So as of this year, see, we are still anticipating some more. See, there are two things. That one is that we are also planning to invest in brand building. That expenses will also start increasing by the end of the year. So we are not expecting any increase in margin this year. In the second half of the next year, you might be able to see some marginal differences coming in.
So, sir, that will remain or that will also go down last year compared to?
So that will remain. So we are not planning to. So we don't plan to expand more than the contribution. So that we are very clear. But you see, this brand building process is a 2-year, 3-year job. It is not a 1-year job. So as the store increases, we will have to start spending also to bring the brand to the consumers.
Got it. And sir, although overall, if I see the overall pie in the first half in terms of revenue, primarily the increase has come from EBOs. For all other channels, it has been just plateau and flat, right? I mean, do you see growth in the other channels also in the second half, or it will remain same? Our main growth will be driven by EBOs.
So Vipulbhai, Hitesh this side again. Our focus will continue on EBO as a channel because that's the better gross margin channel, right? And it's closer to the customer, closer to the consumers. The other channels, we don't want to push very hard for the simple reason is that the more we push hard, it will be at cost of margins, right? So not that there is no growth available in those channels, but growth with protection of margin or growth with, at cost of margin is what we don't look forward to.
Got it. And it is like, what is the current market? We are already in say November, and the peak season is almost started. How do you see what is the environment looking like? What is last year? Last year, our second half was also not too good.
So I think the last year second half continued in this first half of this year. Probably it looks like the worst is over. I think GST changes also pushed consumers to retail. We recorded a same-store sales growth of 24% in October. That was the highest that we have seen so far. And I think the trend in November also continues positive. The winter season also has come in time. So we are heavy on North India and West of India. So winters are also very important for our business. They also, the cold has started in time, and we are expecting that second half will be better as compared to the second half of last year.
Got it, sir. And I mean, can we consider like a year-on-year 20% growth in our top line? Is it achievable in terms of on a year basis?
I think our effort is always towards achieving that, and let's hope for the best.
Okay. And so from a EBO's response, I mean, earlier I remember in the last call you stated about 1.5 years as a payback period for EBOs. So is it
Yes.
the similar kind as you open more? You said looking at the response, it's the similar percentages or similar payback period you see as of now also, or
No, the payback period is going up as we open more stores, right? So that is not constant. That was on a small footprint of stores, but otherwise the payback is getting closer to industry standards.
How much it would be, sir? Then now it's not 1.5 years?
Currently, it's currently between 2.5 to 3.
Okay. But one last, sir, what is the target EBOs which we are considering as a year-end?
So we have projected 36 EBOs to be opened in this financial year. We opened 13 of them in the first half. A few properties got delayed. So we have signed in all about 33 EBOs already. All of them will come in this financial year. And we are supposed to sign 3-4 more, which we'll be signing very easily. So we'll be on target by the year end.
Okay. And so, sorry, one point on the payback. From 1.5 to 2.5, so that's a significant change. I mean, any reason behind it that such significant change would have happened? Because I remember you explained in detail that why it was like short or payback period in terms of because we get profitable from month one and even our return ratios per average sale price, everything would look fine. And any reason for the significant change that has happened in there?
Vipulji, there are two things in this. One is that if you will see the industry-wide phenomena is that first half of the year has not been very good for any of the brands in retail. The consumer demand as such was very muted in first half. Especially August and September for most of the brands have been very bad. So, our stores are also very new. Most of the stores are 5 months, 6 months, 7 months, 8 months. It is too early for us to actually comment on the payback period also because even the seasonality is playing a big role right now. If the first 6 months were not good for not only for us, for any consumer retail in the fashion segment, you will see the commentary. So everybody has rebounded in October. Everybody has seen good growth in October, which is in line with what we have seen. November also, for the first 12 days, we have seen very consistent numbers. So we are anticipating that the numbers will improve in the second half, and it will not be wise for us to comment on payback period as of today, to be very honest with you. It is not right also, because numbers are also premature. There was also a seasonality impact, and our size is also not very big. We will be able to comment on that when we have a sizable numbers for a large period of time, for 1 year, 2 years, when we have operated the stores. That will be the right time for us to comment on our payback period also. I hope I am clear to you.
Yeah. Okay. That's right. It goes significantly. Anyway, no worries. And overall EBOs which we have opened in terms of, if we say the response in terms of other than the online other EBOs, is it how it has been other than considering despite the slowdown in the industry, we see encouraging response? Because when I go nearby stores, even the weekday, I see people are shopping there.
So we have we are very optimistic, and our numbers are also very optimistic, to be honest to you. That's why if you will see, we are in line with our original projections. We had given a market understanding that we will be opening around 36 stores by end of the year, and we will be following up, and we will be closing that number by end of the year. If you will see our numbers of our ASP continues to be high, 1713. Our sales per square feet is also 16,375. So the numbers are encouraging, but the overall market demand was very muted in first half. It is not only for our brand, it is, again, I am very specific that it is an industry-wide phenomena. We have seen a rebound also. To be very frank and to be honest to you, we have seen a rebound in October, and November is also looking very promising to us.
Okay. Thank you. All the best.
Vipul bhai, just to add one point to this. You there?
Yeah. Go ahead, sir.
Yeah, okay. So the sales per square feet number, in spite of new EPOs, has marginally grown over last half year. ASP also has grown, right? Average billing also has grown marginally. And regarding the payback, there is one more point, is that we are opening more COCO stores now. Earlier it was COFO stores. So the payback in terms of company, the payback was very low at that point of time because the investment was low, right? Now we are also investing into CapEx, and hence the payback also marginally is getting delayed because of that. That is also one of the reasons.
But I think it is very premature to discuss payback, to be very frank, Vipulji. I think give us some time. We will be in position some time to be very precise that what will be our payback for the stores. What are we seeing and what we can anticipate in future.
Sure. And sir, on the store expansion, what after this year, is it like, if we keep getting a good response in terms of, can from a 3 to 4 year perspective, can we target to something around 250 plus stores in terms of 3 years?
So as of today, we are opening 3 stores a month. Our target is to open 3 stores a month. Hopefully we will improve on that I don't know, I am not sure, but at least that number we will continue with that minimum.
Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants of the conference that if you wish to ask a question, you may press star and 1 to join the question queue. Our next question comes from the line of Rushank Patel from Orion Global. Please go ahead.
Thank you. So my first question is, as you position the brand in the mid-premium segment, how do you maintain the balance between quality and affordability?
Balance between
Quality
and affordability.
Quality and affordability.
Yeah. So quality comes naturally to us because we have been in business for last 30 years and we have consistently being loved by consumers. nothing at cost of quality. Sleepwear also needs to be high quality for the simple reason that the usage of sleepwear is almost every alternate day. The usage of sleepwear is that the entire body weight gets onto the apparel. So if you have an inferior quality starting from yarn level to fabric level, the sleepwear will really give away very soon, very shortly. So nothing at cost of quality. In terms of affordability, we are trying to position the brand as premium as possible, because we have primary two channels. One is the trade. Okay, trade will always keep products affordable, otherwise people will stop investing into your products. So that is one area which always keeps us on check, and our EBO allows us to go premium to charge that extra money from customers who can afford and who are future forward and design forward.
Okay. And have you observed any elasticity in the customer demand when, to attempt to move prices slightly up to the ladder, and how does it influence your sourcing and pricing strategy?
Sir, so to be honest to you, we follow a price laddering model in our stores and in our trade also. So if you will go to our store, you will see the garment price starting from 1499, and you can see up to 3,500 rupees. So for a consumer who is walking in and who wants to start buying the sleepwear, we have the right product from where they can start. Our training to our retail executive is to take the customer to more premium and more fashionable product. So that's how we are also transforming our consumer journey from a mid-premium to a premium category in our stores. That's how. So we are not doing that. Pricing will only go up. We will start laddering the products in the stores and in the trade also. That's how we manage it.
Okay, but in current intensity of your competitive intensity, so where you are extracting your cost leverage to sustain margins without diluting brand perception, like into vendor negotiation or market efficiency, or design innovations. So where you are exactly extracting the cost leverage to?
So you are absolutely bang on. So first is design plays a very big role in extracting the cost efficiency. Second is also vendor. We have very old and very developed channel for vendor customer supply. We also take a lot of leverage in that accessing that. Also, we are moving around the globe to see which fabrics are available, which are affordable, good quality sleepwear. We also try to bring back fabric to India. So it's a overall strategy how we try to manage the product costing against the pricing how we are doing in the market.
Okay, great. And sir, my third question is, as you are receiving, more direct product feedback from exclusive brand outlets, how has your product development process improved?
That's one of the most significant change that has happened in the organization, because now starting from our design team to our sourcing team to our product team, they are all able to visit EBOs, understand the consumer feedback firsthand, and we also time and again send all the people to retail for them to actually experience the customer feedback, pushback or appreciation, whatever it is. If there is an appreciation, they will be motivated. If there is a pushback, they will improve in their areas.
Okay. And any example you can share where your consumer insights from EBOs led to tangible change in your current design market strategy, any commercial outcome of that decision? Any example?
So we were getting insights from retail that if we get into licensed product, that is, Warners of the world or Snoopy's of the world, there would be more traction amongst consumers. So based on that feedback, we launched, I think, almost 4 franchisee licenses so far, and it has become a 15% additional business for us.
Okay. And are you integrating any structured analytics? Sorry, any structured analytics or CRM tools to capture capture and interpret EBO level feedback?
So, one is that, sir,
we look back into your product innovation and invent with the same thing.
So first is, in the introductory call, management has clarified that we are in process of rollout of CRM. In this quarter, our CRM will be active on 100%. So we will start analyzing data and retargeting the consumer based on that CRM. As far as the structured data is consumed, we have our own software which is actually currently installed in all stores across India. So every feedback that is received from the consumer, the data is compiled centrally, and we have dedicated team who is looking after that feedback. First. Second, we are also monitoring the genders which are walking in, the age group which are walking in. So there is a lot of data science that is going in the data that is receiving at our central head office. And we have developed a team who looks after that and who gives feedback on that data continuously to front end and back end both.
Okay. And as I see that there are many stores you have, like in Mumbai, Pune region, Nagpur, such as Overham Mall, Viviana, etc. So which of the geographic location is more profitable or something?
So north and west, both of them are equally profitable for us. South stores are little below average, but some stores have started showing very positive signs.
Any particular reason because the profitability is varied amongst all the stores? It is about location or people and people choices.
So I think profitability exponentially increases with top line. So if a store is doing 10 lakhs and another store is doing 15 lakhs, the 15 lakh store is definitely going to be much more profitable, right? Because a lot of expenses then becomes constant, right? The variable is only the product cost. So our stores which are high throughput like Palladium, Ahmedabad or Mumbai airports, we have 3 stores now, right?
Okay.
Pune, Wakad, all these stores which are top performing are highly profitable.
Okay.
So,
Yes, please say.
No, just to clarify more. So you are absolutely bang on. In retail, there are a lot of different components which are affecting the profitability. First is location. If you have the right location, then 80% of the battle is won. Second is manpower at floor. If you have the right team, they will turn it around. Third is product.
Right.
Yes. So there are a lot of things which influence profitability. We cannot denote only one single factor to different profitability.
That's why I asked any particular reasons, for the varied profitability or something. So that's why I asked the particular question.
Yes. That is the reason. Location choices might be one of the reasons for difference. And the team develop.
Yes, please go ahead.
Team which is at floor is making a lot of difference. Some stores that were not performing when we changed the team, they are doing wonderfully well even in South. So there are a lot of things we are learning from them, and we are still in that improvement phase, to be very honest with you. South initially is not been very positive. Slowly we are seeing some positive signs with some stores doing well for us. So still it is premature. Probably we will be able to tell you by next call. South is still an area of concern for us.
Okay, fine. That's great. Are you exploring categories beyond sleepwear?
No, we are completely, there is too much of headroom here, and we are completely focused on the category.
Okay. Okay, so that's it from my side. Thank you for answering my questions. It was good experience.
Thank you, Mr. Sharma.
Thank you. Our next question comes from the line of Falguni Jain from Yes Securities. Please go ahead.
Hi. Thank you for the opportunity. So I just had a couple of questions. What MBOs are we working with, and what is the price differential or margin differential that we have in the MBOs and the EBOs?
Good evening, madam. First of all, there are two ranges that we are currently manufacturing. We have around 30% of the range which is exclusively for our store, which includes some of the licensed products which we have launched in our store. So one is that. Second is 70% of the merchandise is common between our MBO, SIS or an EBO. That pricing, there is no differential as such at EBO or an MBO. We follow a universal same price for all MBOs and EBOs. I'm sorry, what was the second question?
What is the margin differential that is, and what MBOs are we working with?
So we are working with almost all big MBOs that you have heard of. Like in North, we are working with Bindal, Chunmun, if you have heard of Stanmax, Vijay Store, all big MBOs across India we are present. Mostly we are present. If you visit, you will be able to find our presence over there. As far as margin difference is concerned, there is very huge margin difference because the gross margin in EBO is much higher as compared to our MBO. That is one of the reasons why we have moved to EBO, that we are expecting the increase in not only gross margin but also EBITDA margins across the channel. So our EBO gross margin is around 71.61%, and our MBO margin is in the range of 51%. There is a huge difference in that.
Okay. Thank you so much for answering my questions. All the best.
Thank you.
Thank you. Our next question comes from the line of Ankur Agrawal from Motozac. Please go ahead.
Hi, sir. I hope you're doing fine.
Ankur bhai, how are you?
I'm good, sir. How are you?
Fantastic. Couldn't be better than this.
Sir, I wanted to know, a few months back we spoke, we were running at a run rate of approximately 3.5 CR for the EVO business, monthly run rate. May I know what's the current monthly run rate?
We closed about 4 in October. We are expecting to close around 4.5 crores in November.
Do you see this 4.5 CR run rate to continue throughout this year?
It would average out, yes.
Okay.
Because February, March will be little low. December, Jan will be probably higher than 4.5 as well. February, March will be little low, so I think you can consider anywhere between 4.25 to 4.5 will be the average for the rest of the month.
Understood, sir. So, does it seem like, we might be able to get 50 CR kind of revenue from the EBOs this year?
Yeah, between 45 and 50.
All right. And sir, as of March 2025, we had 51 operational EBOs.
Yes.
So, as of today, what is the kind of revenue we are getting, in the H1 period? We got approximately 20 CR of revenue from the EBOs, and currently we are having 63 EBOs. We had till H1 63 EBOs, if I am right. So may I know, from those 51 mature EBOs, what is the revenue we got, per store revenue or something like that?
We have noted your question. I don't have this number offhand, but we'll come back to you, or you can drop a mail to cs@sweetdrinks.india.com and we'll reply.
Sure, sir. So, sir, Internally, when we discuss, what's the management's target for monthly revenue from any operational review? Like, what is the monthly target we have, sales target?
So on an average, we are anywhere between 6 to 6.5 lakh rupees a month per EBO, right? But the EBO range is far and wide. So we have EBOs which are doing 20 lakhs, and we have EBOs which are doing 3 lakhs, right? So, but on an average, we are delivering 6.5 lakhs per month per EBO.
Understood, sir. And sir, I was like looking at the results and this marketplace and e-commerce revenue, I think we had approximately 13.5 CR in H1 2025, but in this half of the year, we are seeing a drop of 1 CR. It's like 12.5 CR from that channel. So, sir, are we like facing any headwinds from e-com channel?
So you are, first of all, this includes marketplace sales also. So our last year revenue was 13.37 crore, and this year we have clocked around 12.72 crore. If you will segregate the e-com business, in e-com we have grown from 1 crore 42 lakh to 1 crore 92 lakh. So our own website we are growing. Marketplaces, we are facing a challenge that some of the brands are discounting very heavily. If you will see the Myntra pricing, they have gone from Myntra pricing to Flipkart pricing, and Flipkart has gone from Flipkart pricing to Meesho pricing in our category. So their ASP has gone down around 35% Myntra like to like in our category. That is one of the challenges that we have faced in first half of the year. But since we are now doing Omni and we are adding our own stores to both marketplace and our own website, we are hoping that this recovery will be done through Omni in the second half of the business.
Understood, sir. Sir, like I was just thinking one thing. Like I know few brands in Jaipur, Rajasthan, that are even clocking like 50 crore to 100 crore kind of revenue only from marketplaces, clothing brands. And sir, is there any way like just to capture this channel, we introduce some parallel line or a brand which is like which can compete on the average selling price with other brands in the market?
The businesses which you are talking about is a very commodity-led business. It's kind of a commodity business, right? So we are not in that race. We are a fashion brand, and we will continue to be in this space. And we would rather have our set of consumers buy our products and not reach out to consumers who are only seeking value.
Understood, sir. Okay. And sir, I had a question on expenses. So other expenses part in our financial statement, so that is approximately 32.68 CR. Whereas in H1 last year, it was like 24 point something, right? So may I know, like, how much of this is the new EBO leasing expense or some other kind of expenses like which?
So leasing is around 3 crore 15 lakh. CAM, which is the maintenance of the EBO, is around 45 lakh.
Okay.
And commission, which is franchisee commission, has increased by about 2.35 crore. This is the increased amount which I am telling. So there is an increase of around 7 crore 60 lakh. Out of which 3 crore 15 lakh is rent, 45 lakh is CAM, and 2 crore 35 lakh is commission.
Sir, commission for?
Franchisee.
Okay, franchisee commission. Understood.
Yeah.
And sir, you mentioned that initially you were going with company-owned franchise-operated model, but now you're also exploring what was that model? COCO, company-owned, company-operated, is that?
Correct.
And sir,
So we operate in all three models.
Yeah.
We operate in all three models. We operate in COCO, and we have some FOFO, very less FOFO, but mostly it is in COCO and FOFO.
Understood. So, sir, what's the reasoning behind exploring or going more into COCO model now? Because it requires more money upfront.
The reason for going into COCO model is there are certain malls and very highlighted properties where having a franchisee is not going to be meaningful. It requires very high intensity supervision, monitoring, and decision taking, right? So a layer of franchisee at high rental, high opportunity malls is not in the interest of company. So wherever, how do we decide on where to franchise or not is based on the geography, based on the potential of business, and based on our management bandwidth of managing the operations in that location.
Understood, sir. Makes sense. And sir, one thing I want to ask is like, you told that you will try to maintain the guidance of 20% CAGR for revenue. And sir, for doing that, we might need to do 125, 130 CR kind of revenue in H2. And sir, how realistic does it look at this point, that we might be able to hit that milestone?
So, we have not given a 20% growth CAGR guideline. What we have told is that we are expecting to grow in high double-digit numbers, and we are hopeful that we will be able to deliver in the second half.
Yeah, understood, sir. So, sir, like, does the revenue I'm talking about looks realistic, or like we'll have to wait for the second year for that?
We will have to wait for the second year. But if you will see, our business in second year is highly treated.
Yeah.
So I think you can make out from the past trends also.
Yeah,
and the IPO growth story that we have already told.
Understood, sir. Sir, actually, I was like expecting, our PAT to jump a bit more because we have such a high gross margin. Our material cost is less. But yeah, we had these 7.5 CR of additional expenses. So, sir, like in H2, will this expense remain same or will this jump, leasing, maintenance, and commission?
No. So that is basically related to the stores. So the higher the stores we add, the higher commission and the rent will go up. So this will not be stagnant. This will increase further once we add more stores.
Yeah, sir. So, sir, like,
but we have to see what is the store contributing to the margin. Basically this, that's what we are trying to tell, that initially we are not expecting an increase in margin, at least in the current year. What we are anticipating is that second half of next year we will start seeing the difference. Also, you will also have to understand that we are also planning to invest in marketing in the coming period.
Sir, what kind of marketing are we talking about? Like some brand ambassador-led marketing or something like that?
So it will be more focused on digital marketing. So we will have some media buyout plan. It might be different kinds of media, but not brand ambassador-led marketing.
Understood. And sir, last question, if I may. So let's say we add more 35 stores by the end of this financial year. So this leasing cost of 3.5 CR, like, what is our projection? Like, where could it end up by the end of this financial year?
3.5 crore is the additional leasing cost that we have incurred in first half.
Yes. So how much more can it increase?
Overall leasing cost is around 5 crore 36 lakh for first half. That completely depends on how much, what is the size of the location, where is the location, what rental we are expecting, and whether it is COCO. There are a lot of different things involved in this. But it will certainly go up. That's what I can tell you. It will certainly go up.
Understood, sir. Sir, thank you so much for all the answers. Thank you, sir.
Sure. Thank you and goodbye.
Thank you. A reminder to the participants that if you wish to ask a question, you may press star and 1 on your touchtone phone. The next question comes from the line of Dhanraj Solani from Kirin Advisors. Please go ahead.
Yeah, good evening, sir.
Good evening, Dhanraj bhai.
I just have like 3-4 questions with you. So I'll just start with the first one. So just wanted to know, like, your exclusive brand outlet currently has around 64 stores. So could you talk about how the older stores are performing compared to the newer ones, or what patterns are we seeing across store groups?
So it's a very clear indication that store matures after a year's time. So all stores which are 1 year aged and above, they deliver different kind of an EBITDA, much higher as compared to stores opened within last 1 year. There is a substantial difference.
Okay. And with sales per square feet improving, so what are the main things we keep doing inside the store to keep raising productivity?
Sorry, I didn't get your question, Mr. Dhanraj.
As we can see, the sales per square feet is improving. So what are the key things we are doing inside the store to keep raising productivity?
So inside the store, it's inside the store, the entire game is happening inside the store. So first and foremost is we are focusing more on visual merchandising. How do we display our items? How can we reduce the time of fulfillment from the back stock to the customer to the billing counter? So that's one area. Second thing is we are investing on training our front-end people, right? What is the brand message? What is the story of the brand? How do we impact a mood-based sleepwear? What is the importance of creating a sleepwear wardrobe? So all those education training is happening to our training staff. Third thing is we do product innovation. So price point ladder, we always, every season, we keep on stretching. So earlier we used to have products which were, highest price point was 2,500. Now the highest price point in the store has gone up to 5,000, right? So all those things, interventions, we continually keep engaging, innovating, and studying.
Mm-hmm. So, like the big stores, or you can say the main stores, is becoming a large part of the sales, I would say. It's becoming a huge part. So how are we seeing idle store rollout in the future?
Sorry, again, you will have to repeat your question. I did not get it clearly.
Okay. So what would be the ideal store rollout as the main outlets becoming the larger part of the sales, as the majority of the revenues would be coming from the major outlets, I would say. What would the ideal store rollout?
So currently 600 square feet is our ideal store size. Okay, we are opening 3 stores a month, but not always we get a 600 square feet store.
Yes.
Not always we get a 600 square feet store, but the ideal store size is 600 square feet.
So, the company, I would say, reaches with the different states through trade distribution. But when it comes to the exclusive outlets, so which cities, or I would say regions, are showing the strongest customer demand?
North and West, practically.
Okay. And are we facing any changing in demand risk? Let's say today some kind of style is happening, and another movement is the style is out of updation, I would say. So are we facing some issue?
See, as long as you keep your eyes and ears close to the market, I think there is always a calculated risk which is as part of the business, any fashion business. But we are very close to our consumers, so we don't have any such shocking revelations happening so far.
So we don't hold inventory. Like, let's say we are holding more inventory after forecasting some demand. Like we are forecasting a good demand, and we are holding a huge amount of inventory, and then it's going out of time. So what would we?
No. I think we are not facing such challenges.
Okay. Okay. See, that's all from my side.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Ganesh sir.
Thank you everyone for joining the conference call of SD Retail Limited. If you have any further queries, you can write to us at refresh@kirinadvisors.com. Once again, thank you everyone for joining the conference.
Thank you.
On behalf of Kirin Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you. Bye.